Okay, this video is on QuickBooks Online Advanced Certification Section 2 Inventory Management. The topics covered are inventory tracking, FIFO, product categories, revaluing, inventory, donations, and gifts. So inventory management is an essential part of any retail business. This feature in QBO tracks quantity, purchase costs, sales revenue, and cost of goods sold for inventory items. To start tracking inventory, you'd go to the gear icon, select Account and Settings, and then go down to the Sales tab. And in the Product and Services section, you would select the checkbox next to Track Inventory Quantity on Hand. This will automatically add an inventory item option under the Product and Services. Then under there, you'll notice two other options that are selected, and that would be Show Product Service column on the sales form, and that adds a product service column onto the sales form so you can choose from a list of products and services to include. And then the other option is Track Quantity and Price Rate, and that adds quantity and rate fields to sales form so you could track this information in the product and service area. Then you would click Save. So here's a question you might come across on the exam. Which three actions are required to track inventory in QuickBooks Online? That would be checking the settings to track inventory quantity on hand, checking the setting to track expenses and items by customer, and checking the settings to show product service column on sales form. So there's several different methodologies used for inventory management, but the one they focus in on here in the Pro Advisor section is FIFO, which is first in, first out. It's an inventory tracking method that could be used in both Plus and Advanced subscriptions. So here's a table from the training section that depicts a company's January 2018 month of purchases and sales. So we see here on the 5th, they purchased 10 units at the cost of 10 each, totaling $100. And then 10 days later on the 15th, they purchased 20 more units at the cost of $12 each for $240. So with the first in, first out, your first items, or let's say inventory in your inventory closet, the first items you purchase will be the first ones to go out. So when we make our sale, we're going to take it from this 5th purchase date. So on the 18th, we made a sale of 8 items. So those 8 are going to come in from that 5th order. And so it values at a cost of goods sold of $80 because we paid $10 each, leaving us now with 2 items from the purchase on the 5th. So when we made a sale on the 25th for 5 total items, 2 of them are going to be from the 5th. And then the other 3 by default would go to your next purchase, which is the 15th at $12. So we'd go 2 times 10 is 20. 3 times 12 is 36. So our total cost of goods sold would be $56. Now, when we go to our journal entry, we'll see 2 separate line entries for inventory because this is what you call FIFO layers. Here's another question. So they'll have a scenario, and in this case, it's Laura Landscaping scenario, and they'll have a link there for you to click on, and this PDF comes up. So we're going to look at that in a second. So the question they ask you, according to the information in the PDF, is they want you to round up to the nearest cent what is the ending inventory value for ornament trees and decorative spotlights as of October 31st of the current year. So we're going to look at this PDF, and this is the PDF for Laura's Landscaping. So let me scroll down a little. You can take a picture of this, or if you want to write it down, this is exactly what you're going to see. So the following entries were the only entries recorded in Laura's Landscaping for the month of October. So on the 15th of the current year, she purchased 10 decorative spotlights for $10 each and 10 ornament trees for $125 each. So you would write somewhere on a piece of paper, 15th, 10 decorative spotlights, $10 for $100, 10 ornament trees, $125 for $1,250. Then on the 20th, she discovered 6 of those decorative spotlights were defective and sent them back to the vendor. So now we're going to say -6 or -$60 from our decorative spotlights, leaving us with 4 at the value of $40. Then on the 25th, she purchased 3 additional decorative spotlights for $10.50 each and 10 additional ornamental trees at $110. So now we have 7 decorative spotlights, 4 from the 15th, 3 from the 25th, and then we have 20 altogether ornament trees, 10 from the 15th and 10 from the 25th. So these are things that you should be writing down in your notes, like, or you could either write it out or put it in a table and helping you do this problem. On the 27th, one of Laura's employee, Joe, drops an ornament tree from the truck and it was damaged beyond repair. So she just has to take that out of inventory and take it as a loss. So that one, being FIFO, we have to do first in. So we're going to take that one tree from this 15th over here, the one tree for $125. So now we have 9 ornamental trees for $125 and 10 for $110 in our inventory closet. Now, on the 28th of the current year, Laura creates an invoice from Francie's Fitness Center for the following items. So Francie's Fitness Center bought 12 ornamental trees, 6 decorative spotlights, and 4 hours of labor. Now, the 4 hours of labor have nothing to do with the FIFO. We only look at inventory here. So we're focusing in on the ornamental trees and the decorative spotlights. So I'll go back to my PowerPoint and we'll look at that purchase. So let's look at decorative spotlights first. So as we said, she purchased 10 on the 15th, but 6 were damaged. She returned it. So we had 4 items here from the 15th. And then we purchased another 3 additional items on the 25th, giving us a total of 7 items in the decorative spotlights. So we sold 6 of them to the fitness center. So we're going to take the 6, 4 of them from the 15th and 2 of them from the 25th, leaving us 1 left from the 25th. So there's only 1 item at $10.50 for the decorative spotlights. Now let's go down to ornamental trees. So we have 9, because remember 1 was damaged by her employees. So we have 9 at $125 and 10 at $110. And that totals $2,225 total. Because remember we had the -1 and we took that from the first order. So we have 19 now. If we purchase 12, okay, so the fitness center purchased 12. 9 of them are going to come, because remember it's first in, 9 of them are going to come from that 15th purchase. So all of these 9 are going to go in there. And then 3 of them are going to come from the 25th. So if we're taking 3 of them from the 25th, that leaves us 7, correct? So we're calculating ending inventory. So that means what is left over? There's 7 ornamental trees at what price? At 110. So we would multiply 7 times 110, we get 770. And we add it to that 1 decorative spotlight that costs $10.50, leaving us with the total ending inventory of $780.50. Hope that made sense. If that gives you a problem, shoot me an email and I'll try to explain it a little bit more detailed. Adding an item to inventory. So you're going to go to either your sales center and then select product and services, or you can go to your gear icon and select products and services. Then you're going to click the green new button and then select inventory from the pop-up window that comes up. Then that enter inventory information comes up and you're going to enter the name and the initial quality on hand and the as of date. Now note these 2 things. You should always enter 0 for the initial quantity on hand, since anything greater than 0 is going to adjust both the inventory asset as well as offsetting the opening balance equity. And you want to try to avoid using that account if you can. So what you do is you put a 0, even if you're the QBO advisor and you're setting up a client, put 0 for the initial quantity and then increase quantity by using the purchase forms. The other thing you want to note, the start date. So the start date cannot be changed once you put it in there. So any transactions of these items that might have been sold earlier are not going to be acknowledged. So you want to make sure to select the start date prior to any purchases of those items that you have to backtrack. Adding an item to inventory, continue. So now at this point, you can also enter a reorder point. So that's where QBO will notify you when the quantity on hand drops at or below the reorder point. So while you're setting up your inventory, there's 3 accounts that you have to link to that inventory item. The first one is your inventory asset account. That account must have the type other current assets and the detail type inventory. The second one is your income account, your revenue account. The account must be an income type and the detail type must be sales of product income. And then the third one is your cost of goods sold. And that account type has to be cost of goods sold, and the detail type must be supplies and materials, cost of goods sold. Also note that some products you sell might have, might be taxable and have a sales tax associated with it. So then you're going to select the sales tax category field and what you sell field. You'll fill that out. Lastly, you can also choose one preferred vendor. This means that if you reorder the products from the product and service list, the vendor's detail will automatically appear on the purchase form. So then you're going to click Save and Close. Note, you can also import inventory from a list. And to do that, you would go to the gear icon and then Import Data, and then select Product and Services. Now, if there's any imported information that already exists within your products, then it'll just update that existing product. So here's a question you might come across. You instructed your client to always put 0 for the quantity on hand when creating a new inventory product. When creating a new product or creating a new item, your client mistakenly enters the beginning quantity of 20 and a cost value of $25. So he forgot to put that 0 and he's saying, oh, no, I have 20 of these and they cost $25 each. What would be the effect on your general ledger when a mistake like this is made? So remember, I said it affects your inventory asset and your opening balance equity. So this is exactly what you would need to do. You'd need to multiply the quantity by the price. So we're going to take 20 times 25 and get 500. Now, these are not the same numbers, but I believe this question comes in a few different forms. So I didn't use any of the same numbers. So just know you have to multiply quantity by price. That's the number you're going to be using. And you always debit inventory for that amount and credit opening balance equity for that amount. Okay. Here's another question. A client is currently using and tracking inventory on hand. They're considering using the FIFO method for tracking inventory with QBO. What is the best way to see line items affected in the sales transaction? So you want to see what accounts are actually affected, especially with FIFO. You want to see if there's, remember I was saying you have products that are $10 and you have products that are $10.50. You want to see the layers of those accounts in your journal entry. So how would you do that? You would open the customer invoice and then go to the bottom and select the transaction journal. Product categories. Product categories can help your client better organize their inventory and make it easier for employees to identify specific items. To get started, you would click in the gear icon and then you would select all lists and then you would select product categories. Another way is to select sales and then product and services. And under the more drop-down list, you can select manage categories. And then a third way is if you're adding a new inventory item, you'll have an option there to add a new product category at the same time. You can add a new one or select one that's already there. To do it from the new inventory form, you select category from the drop-down and select add new. All right, 3 statements that are true regarding product categories. The product category list can be filtered by the product category. An existing category or adding a new category can be specified when adding a product service item. And the last one is entering the name of a product category in a purchase or sales transaction will produce a drop-down list of product and sales that are in that category. So those are 3 true statements regarding product category. Next question. All right, so when we purchase an item, what happens? So you're going to purchase an item, and if you pay cash, obviously, we would have cash instead of accounts payable. But in this example, I purchased something on account. So I would debit my inventory asset and I would credit my accounts payable because I would be paying it later. Now, when I sell that item, if I use the perpetual inventory system, I would have 2 sets of journal entries. The first one I would have here. So I sold the item to a customer that's on account. So I'm going to debit accounts receivable for $250 and I'm going to credit my revenue account, which is sales of product income. So we debit our asset accounts receivable because I'm billing my customer and I'm crediting my revenue account. Now I immediately under the perpetual inventory system have to acknowledge my expense, which would be cost of goods sold, what I paid for that item. And I would immediately take the inventory out of my asset. So I'm going to debit the cost of goods sold and credit my inventory asset, showing that that item is immediately removed. Now, if you have like an antique dealership or a car dealership, you might use the periodic, which you wouldn't need to do that immediate step, the second step. But if you're a retail store, you're going to need to do that second step and know what your inventory on hand is at all times. Purchase order, another purchase order question. Considering the following, on April 2nd of the current year, Sarah bought 80 bags of mulch for $640. On June 12th, she bought 75 bags at $618.75. And on June 1st, she sold 125 bags to Smith Landscaping. What is the debit entry to the cost of goods sold when Sarah records the sale to Smith Landscaping? So just as we saw in that second step, we acknowledge the expense and take out our inventory. So we'd be debiting the cost of goods sold on what we paid for it. And if it's 125 bags, using FIFO, I'm going to use my first purchase. So my first purchase was 80 bags at $6.40. So I'm going to immediately just bring this 60/40 down. So 80 of the bags totaled $6.40. Now I have to take 45 of the bags from the second purchase. I have to find the price per bag. So to do that, I put this little asterisk here. I take the $6.1875 of the total and divide it by the number of bags, 75, and I got that it was $8.25 per bag. So I'm going to take that $8.25 here and multiply it by 45 to give me $371.25. I'm going to add this $371.25 to the $6.40, and that's going to give me a total of $1,011.25 as the debit to cost of goods sold. That's what we paid for it. What are true statements? I have a spelling error there, sorry. What are true statements about purchase orders in QBO? You can close individual lines on a purchase order. You can add purchase orders to any type of purchase transaction, and you can add multiple purchase orders to one purchase transaction. Partial orders. I'm covering this because it is part of your training method, and I haven't come across any questions. Nobody shared any questions with me on this, but I still want to make sure I cover it in case there are any questions out there, or if they add any questions to the test on this topic. So let's see how a partial purchase is recorded. First, you're going to start with an existing purchase order. So let's say you ordered 20 units of a product from your wholesaler. After getting a call from the wholesaler the next day, they said, listen, we don't have 20 units, which is very realistic today in our pandemic with the coronavirus. So you may very well get a call from your supplier saying, look, we don't have that. We're going to send you what we can. And they sent me 10 units instead of 20. And I'm getting billed for 10. So to record the transaction against the purchase order I had already created, I'm going to select copy to bill. I'm going to record the quantity received as 10 units against the 20 order. And then I'm going to select save and close. In the expense transaction list, you're going to select the original purchase order. Note that the quantity on the order has changed to reflect the partial purchase receipt recorded. This activity has updated the inventory, adding the quantity received and, of course, recording the expense. It is also reflected in the quantity on purchase order column in your product and service list, so that any remaining items to be delivered as part of this purchase order are shown as still on order. Here's a visualization showing you that you can create a check, expense, or bill and add the purchase order to it. And you can see that right here on the right-hand side. Adjusting inventory levels. Let's look at how to adjust for any discrepancies in stock level if items are damaged or lost. So you're going to select the plus new, you're going to select inventory quantity adjustment, select the inventory adjustment account, and then select the product or service to be adjusted. QuickBooks Online will enter how many units it thinks you have on hand at that date. Enter either a new quantity or the change in quantity, and then save and new. The other way to get to the same screen is to open up the product service list and edit the inventory item, and then select quantity next to adjust. When saving the inventory adjustment, QuickBooks Online automatically records the inventory adjustment to both the inventory asset account as well as your inventory shrinkage cost of goods sold account. Unless an account other than that was chosen, but that one is the default that's automatically created by QuickBooks Online. You can easily adjust the quantity for multiple items on one screen as well. How do we do that? You start by opening the product and service list, filter the list for type, inventory, and then select apply. Then select which items need to be adjusted by checking the box on the left column. At the top right of the grid, select the drop-down under batch actions, and then select adjust quantity. This will list all the selected items in one adjustment form. Then you would enter the quantity on hand for each item. You would enter your adjustment date, and you would put all your inventory adjustments, and then you would select save and close. An inventory adjustment can be deleted. So how do we do that? You open up your chart of accounts, you go down to accounting, select chart of accounts, and then you select the account inventory asset, and then you select the action link to view the register, and then you would identify which adjustment you would want to delete, and then you select delete at the bottom toolbar. To record a promotional sample, you can record it as a sale that has no income. So suppose you have a customer that has never used you before, but you think, wow, I'm going to have like really great opportunity if I can grab this customer. So you might give them some free products. Or the example in the training was, you had products that were coming near to the expiration date. You figuring you weren't going to sell them, so you'd rather give them as a promotional or gift deal, or even a donation maybe. to a local charity group. So how would you record this? You would go to your plus new button, select the sales receipt, select the customer to that sale, and then in the product service section, select the product that's being given away. You're going to change the rate to 0. So that product's going to come up, and it's going to come up with the sale price item that you set up when you first put in that inventory, and you're going to change it to 0. This way, your sales receipt is 0. Finally, you're going to click save. Sorry, you're going to click save. This creates a $0 transaction in the bank register of whichever bank account was used for the transaction. This sales transaction recorded 0 income, so it also recorded the associated cost of inventory, meaning whatever you put when you set up the item, whatever you said the cost account was, that's still going to debit cost of goods sold and credit your inventory asset. It's just going to show that you had $0 in the bank and $0 for revenue. If this were a donation, you may want to reflect this donation in a donations account. To do this, you can create a journal entry to move the cost of the donated item out of the cost of goods sold, so you would credit it, and then into your donations account, and you would therefore debit your donations account. Before you create the journal entry, you would need to look at the transaction journal to see exactly how much was posted to your cost of goods sold. Because remember, we talked about earlier the FIFO layers. So there might be several different costs to those items. To create the journal entry, you'd go to plus new and then select journal entry. And in the description, you're going to add fundraiser donation, and then you would list your customer's name. In the name column, you would list your customer's name, and then you would select save. You might think that you can use an inventory quantity adjustment to reduce inventory for donations. However, using that method will not allow you to enter a name to a specific customer that you donated to. Here's a question with that topic. A client wants to donate 5 widgets set up as an inventory item to a charity. In the item setup, you had the cost at $5 and the sales price at $10. Now, this is where the question, because then they threw in this information. 50 widgets were originally purchased at $6 per widget. Now, they just gave you that information, but they told you when you set up the item that the cost was $5 and the sales price is $10. This is just the software system. So if you told them the cost was $5, although they're telling you in this problem, it's not really 5, it's 6, but you told QBO it's $5. That means that when the QBO calculates the cost of goods sold, they're going to use the $5 as the cost. So what is the effect on general ledger when this is recorded on the sales receipt? You bought 5, you donated 5. So you would take 5 times the cost that QBO thinks it's at, $5 would be $25. So you would debit cost of goods sold, $25, and you would credit inventory, $25. Now, just as a note, they said this was a donation. So then you could follow up later to take it out of cost of goods sold, as we just read in the previous screen. You can debit donations and credit cost of goods sold and take it out of that and put it into that donation account. Here's another question. A client has a handful of inventory items that are about to expire. They've decided that they will send these products to customers free of charge as samples. Which method of adjusting the inventory should be used to ensure this is recorded against the customer? You would create a 0 sales receipt or invoice and then enter a journal entry to adjust cost of goods sold and promotions, as I just noted as in the last one with the donations, reversing it by debiting your promotion or your donation and crediting your cost of goods sold account. Revaluing inventory. Let's say some products have been damaged and you want to revalue them down. You would create an inventory quantity adjustment by selecting the plus new button and inventory quantity adjustment. Create a new inventory adjustment cost of goods sold account called obsolescence. On the inventory quantity adjustment screen, you're going to reduce the number of the product to 0 and affect the new obsolescence account. Then you would select save. The impact on this is to reduce the inventory, both the quantity and the value, to 0. Remember though, these items are on hand, but they're merely just damaged. So we account for the revaluation of the product by creating a new expense transaction. So now we would open up an expense transaction. No vendor is needed here. The date of the transaction must be the same as your inventory quantity adjustment date. You would need to identify a bank account for this transaction. Although you can use your checking account, that might be confusing for your client to see a $0 transaction when reconciling. So instead, set up a bank type of account called clearing and use this account in the transaction. In the items detailed grid, buy the products for the new valued amount. But next, we also must show that there were no money exchanged here. So in the account details grid, select the obsolescence account and affect it by a negative revalued amount so that the total expense transaction is actually zeroed out. Remember, in recognizing the reduced value of the products, which I have another spelling error, I apologize, you are not actually spending any real money here. In effect, although we're creating a purchase, we're reducing the amount of the expense payment to zero by using the negative amount for the obsolescence account in the accounts detail grid to offset the amount in the items detail grid. So here's a question you might see. What are 3 statements about revaluing inventory? An inventory valuation adjustment must be created. Best practice is to use a clearing banking account type to record entries and use an inventory adjustment to adjust the quantity and value down to 0. And that's it. I hope everybody's doing well. I know this took me a little while to get up, but I'll get the next one in hopefully in the next 2 weeks.